I really appreciate you joining us here today. The backdrop of our next conversation is the unexpected and seismic event that occurred on the 10th of March of this year. The Silicon Valley Bank, a financial institution founded in 1983, and it played a significant role in providing financial financing for nearly half of the United States venture-backed technology companies and healthcare companies that went public in 2022. Yet, on the 10th of March, that fateful day, SVB experienced a catastrophic failure following a run on the bank. And I'll hand over to my co-host, Sinesh Albert, to help lead us further. Over to you, Sinesh.
Thank you, Lester. Yeah, definitely looking forward to this discussion. As we said, the SVB Bank collapse was just the beginning of a series of unsettling events. In the wake of SVB's crisis, we witnessed the closure of Signature Bank and Silvergate Bank, both of which had been instrumental in servicing the rapidly growing cryptocurrency industry. Furthermore, this continued with the collapse of Credit Suisse, a financial institution that had long been considered a pillar of stability. These events left not just the financial industry, but the entire global economy reeling. Today, our panel discussion aims to dissect these events leading to these bank failures and, more importantly, to uncover the root causes that underpin these dramatic collapses. Our focus will be on understanding these themes of risk management and risk culture that played a pivotal role in these favors. Lester, over to you.
But so by delving into these critical aspects, we hope to shed some light into the lessons that these banks and other financial firms can draw from. So we welcome onto stage KOKETSO, MANO, Annelies Snyman, Michael TICHAREVA, to be led in a discussion by Leanne van Oudheisden. Thanks so much for joining us.
So thank you, Lester, Sinesh, for the introduction and for setting the background and context for our discussion today. And thank you, everybody here, for joining us for what I am sure is going to be a very interesting and insightful panel discussion on the Silicon Valley Bank collapse and other recent bank failures. So, as Lester said, my name is Leanne van Oudheisden, and I am delighted to be your moderator for today's discussion and privileged to be joined by a very powerful panel of industry experts who I'm sure are very much looking forward to sharing their knowledge and insights with you. So I'm just going to introduce our expert panel so that you know who we are talking to today. So first up, we've got Annelies Snyman. Annelies has over 15 years of banking and consulting experience, spanning risk, treasury, and then corporate investment banking. She currently heads up FRM, or Financial Resource Management, at Absa Group. Annelies, thank you for joining us today, for making your time available. Then we're joined by KOKETSO MANO. KOKETSO joined the FNB economics team in June of 2021, where she's responsible for macroeconomic analysis and forecasting with a particular focus on inflation and monetary policy. Prior to joining FNB, KOKETSO held an economist role in the South African the South African Reserve Bank's Research Department, where she conducted macroeconomic research, policy analysis, and forecasting. She holds an honours degree in economics from the University of Pretoria and a master's degree in public policy from Wits University. And then last, obviously not least, and our thorn amongst the roses today, we have got Michael TICHAREVA. Michael is a fellow of both ASA and the Institute of Actuaries, and he holds an MBA from Wits Business School in addition to his actuarial qualifications. Michael entered banking practice back in 2008 after initially qualifying as a pensions and employee benefits actuary. And I'm sure that's just because at that point in time, we didn't have the option to qualify as banking actuaries. And fun fact, it's largely thanks to Michael, amongst others, that we do have that option now. Michael leads a team of banking actuarial professionals at Claxton Actuaries International. And he's a global leader in developing banking practice for actuaries. He's been the chairperson of the Banking Virtual Forum of the International Actuarial Association since 2016, and is also a founding member of, and the previous chair of the ASA Banking Committee, amongst many other contributions to the profession. Michael, thanks for being here, and please join me in welcoming our panelists and thanking them for their time today. Excellent. So our hosts have already given you some background. I'm not going to repeat the context that they've shared, but I do want to read an extract from the recent paper published last week by the Basel Committee on Banking Supervision. And what they said was that the banking turmoil of 2023 is widely considered the most significant system-wide banking stress since the Great Financial Crisis in terms of scale and scope. Over the span of 11 days, 4 banks with total assets of about $900 billion were shut down, put into receivership or rescued. These bank failures, while having largely distinct causes, triggered a broader crisis of confidence in the resilience of banks, banking systems, and financial markets across multiple jurisdictions. So pretty serious stuff. And the aim of today's discussion is to unpack the context in which these banking failures occurred, to look at the root causes and contributors to the failures that were experienced, and to focus on any lessons, key takeouts that we can take from this experience, and hopefully at least consider taking back into our own organizations to make sure that we don't experience similar events in the future. So with that background in mind, let's dive into questions for our panelists. I've got a few questions that I'd like to take them through, and then when we're done with that, we will open the floor to the audience to ask any additional questions that you might have for them. Okay, so starting with context. KOKETSO, you're an economist. What were the features of the macroeconomic environment at the time of the failures and in the period leading up to it? What was interesting about it?
Yeah, I mean, it was a very interesting context. So let me start off with the aftermath of the global financial crisis, where you would remember that at that time, interest rates in the United States were quite low, approaching or stuck at the zero lower bound. And so to support or stimulate economic activity, economic growth, the central bank underwent what we call quantitative easing, right? And so we entered an age of relatively easy money, if we can call it that way. And so the markets also got, adjusted to that sort of age of easy money. So in 2013, when the central bank started to communicate that they would be tapering quantitative easing, we had some sort of taper tantrum. And actually, interest rates only started slowly and gradually increasing between 2016 and 2019 in the United States. So we still had a period of relatively easy money going into 2020. You had the lockdowns, weak economic growth, weak economic activity. And so you also have bouts of illiquidity. So in order to intervene, the central bank cut interest rates once again, and we went back into quantitative easing. What's interesting, in 2018, the IMF released a paper where they put out a hypothesis that, it takes time or it's difficult for people to absorb both good and bad news. And so with forecasters, you see that as well. It's very slow process to adjusting to either lockdown or financial constraints and so forth. And the reverse is equally true. And you see that not only in the private sector, for example, but you see that in official forecasts as well. And it also, you will also see that across different regions, whether it be developing economies or developed economies. So with that said, in 2021, when we started to see that inflation was rising, whether it be because of the post-pandemic supply-demand imbalances, we started to see inflation rising. And at that time, at the Jackson Hole Symposium in 2021, the central bank, the Fed rather, was characterizing inflation to be transitory. So that means that they didn't see inflation lasting long enough to create problems at the policy level. In fact, in 2021 September, forecasts were for inflation were for 2% in 2023. Interest rates were only expected to be around 2% in 2024. But how different the picture became in 2022 when inflation rose above 9% in the United States. And now we're actually sitting with the central bank forecasting a peak of 5.6% when you think about interest rates. So it's a very different world right now. It has resulted in the market sentiment changing. It has also resulted in repricing of financial assets. And as a result of that, you would have seen companies such as SVB experiencing losses when thinking about their financial assets, which were long dated at fixed interest rates. So unfortunately, that's what happened. And at the same time, you also had tighter financial conditions, which meant that your venture capitalists, your depositors in SVB were now seeking their deposits. So it highlighted that mismatch between your assets at the banking level versus your liabilities.
KOKETSO, thank you. I mean, very interesting scenario, and I think very interesting to kind of look back and reflect on the differences between macroeconomic forecasts at a point in time and how things play out in reality. I suppose we can't always perfectly predict the future, and as actuaries, we don't always want people to know that. Maybe the economists are a little bit more open to feedback. And I think the environment with the increasing interest rates, with the cost of living pressures from an inflation perspective, really not great, and leading to some unfortunate outcomes. Annelies, anything that you'd like to add in terms of additional drivers that contributed to the events that unfolded?
Yeah, thanks. Maybe, there were a number of factors, looking at rating agencies, the downgrades that came through, but perhaps 4 key ones to call out. I think the first one, reflecting on the high interest rate environment, and I think we touched on it a little bit, was deposit beta. If you look at it at the banks, their deposit beta didn't keep up with rising interest rates, where in the US you'll see money market funds having a one-to-one almost relationship with Fed funds. And that caused a significant outflow of deposits out of the banking system in the US into money market funds as depositors were looking for yield. I think the numbers quoted in the first 3 months of this year was as large as $400 billion got withdrawn out of the banking system and got redeployed into money market funds. Then maybe the other big factor to highlight from a US-specific perspective is the asymmetry from a regulatory perspective. In 2018, we did see a big-scale repeal of the Dodd-Frank Act, which is the act that implemented Basel III requirements into the US. And what they did in a nutshell was that any bank with assets less than $250 billion, which is quite a big number if you think about it, didn't have to implement a number of the liquidity requirements that we've got implemented in the banking system here today. And they also got reprieve in terms of participation in the common stress testing, or CCAR, as it's called in the US, to name 2 key ones that I think played a key role here. I think the other key point to highlight from an industry perspective is digitization. And that is the ease and the speed with which deposits and money can now move within the system. I think if you look at the numbers, you can see that Silicon Valley lost 85% of their deposits in just 2 days. And if you think about the Basel requirements, it's nowhere closely calibrated to that level. And then particularly turning to the bank in question here, it's probably concentration. And that's probably twofold in the sense of their business model, and particularly focused in one particular industry and sector. And secondly, and I think we touched on this already as well, is their reliance on uninsured deposits, where they've got a depositor insurance scheme in the US that covers you up to 250K for your deposits. They only had 3% of their deposits covered. So starting to see that outflow, you can imagine what that concentration looked like.
Thank you. I think some fascinating points there. Talking about the repeal of regulations in 2018. At the time of its failure, SVB was the 16th largest bank in the United States. It's not a lot of banks. $250 billion is not a small number, and yet there was that regulatory asymmetry, which is, I suppose, in retrospect, quite concerning. The second point that I find really fascinating is the one around that speed of action. We've got that, we're working in a digital world where everything is much faster, not just from an access to funds perspective, the ability to withdraw funds, but also from a communication perspective. So SVB provided financing to nearly half of venture-backed technology and healthcare companies that listed on US stock markets in 2022. So concentrated client-based, venture-backed is important because a lot of the withdrawals that happened were off the back of communications between the venture capitalists and the clients that they worked with to say, there's trouble on the horizon, take out your money. If we didn't live in a world where communication via Twitter or X or whatever we're supposed to call it now I feel a bit old, but okay, was a possibility, it probably would have looked quite different. So maybe just a note for the back of the mind on how we think about these things, how we model these things. And I know we've got a talk that I'm looking forward to after this one on modeling bank runs. What is the impact of this kind of new world versus the historical data that we have? So moving on, look, I think it's quite clear there were a number of contributing factors in this space, some of them external with respect to the macroeconomic environment, some of them internal with respect to the way that SVB and other impacted organizations chose to approach things. But many have commented that SVB effectively failed at risk management 101. So, I mean, Michael, I'm keen to get your views. What do you think it is that they got fundamentally wrong?
Right. Thank you very much. Look, KOKETSO have set the scene here, and Annalise, you have outlined some of the external factors. But, you know, if you ask me when I was doing history years back and ask me what were the causes of World War I, I wouldn't finish an essay without mentioning Sarajevo assassination because that was the immediate cause. But to reach to when the bank actually failed as SVB, there were a lot of issues that happened. And you mentioned this report that has just been released by the Basel Committee on Banking Supervision. It was released on 6 October. It mentions a number of failures, mainly to do with risk management. So firstly, their business was growing very rapidly. And I wrote an article in April where I said it was actually exponential growth, but it was not matched with resources within the company. Risk management protocols, risk management frameworks were not consistent with the growth of the business. Just to give you the extent of growth, it tripled in size in terms of the loans it gave from 2019 to 2022. So that's like in 3 years, it grew 3 times. So that's just one example. But that growth was not matched with what was required to actually support the growth. So that was one aspect. Now, there are other aspects. The board and management were actually found not to have been, well, I don't want to use the word competent, but those who are wording it are saying they were not that competent. They ignored a lot of issues. They ignored a lot of risks. They did not understand the interrelationship or the correlation between risks in a bank. There are so many risks across the board within a bank, and some of them, if you look at them at an individual level, you may not be able to appreciate or understand how one risk magnifies the other. You as actuaries, I think this is one area that you deal with a lot. So there was that just internally within the bank. There were other issues such as they didn't have a CRO. I think all of these things are documented. Chief Risk Officer, about 15 months. They didn't have one. The board, only 1 or 2 people were competent risk managers. There were a lot of internal issues, and that led to them as the board and the senior management not paying attention. Now, finally, in this comment, look, I can speak for an hour on this, but on this, the supervisors, the US supervisors, actually understood some of these issues. They actually highlighted these issues. So these issues were actually highlighted, but they were not taken into account. They were not addressed timeously. So for example, when it failed, the very time it failed, which was on the 10th of March, there were 31 outstanding supervisory issues that had been raised, not resolved, which was thought to be about 3 times more than what other peer banks had. So there was just a there was just mismanagement. There was focus on business growth. There was focus on short-term profits. The remuneration policies also supported management going into making short-term profits, equity returns, as opposed to also concentrating on risk management. So for me, I still consider it as total breakdown in the risk management framework of the bank throughout. And that started 3-4 years before it actually collapsed. The day of collapse, that's Sarajevo assassination, which is the immediate cause of World War I, but that's not the actual cause. There were issues behind that. Thank you.
Absolutely. Thanks, Michael. I think very strong point around these things don't happen overnight, and they don't necessarily happen in the shadows either. I think there are lots of things that occurred that were probably fairly obvious to regulators and supervisors, and that's that linkage between information and action that I suppose there are some questions around at the moment. I want to come back to the conversation on specifically risk culture and the role of leadership. But before we get there, I'd like to just pause and dig a little bit deeper into that 2018 repeal on the Dodd-Frank Act side, which has been mentioned, reduced scrutiny over regional banks, removing requirements for banks with assets under $250 billion to submit to regulatory stress testing exercises. Annelies, what is the role that regulatory stress testing plays in preventing events of this nature?
Yeah, thanks. Look, I'm pretty sure for a room full of banking actuaries, I don't have to explain the regulatory requirement of stress testing in terms of, making sure you've looked at plausible yet severe scenarios and you remain adequately capitalized from a regulatory perspective. But I think that really is just the regulatory requirement of it. Stress testing should play a key role for management, the board, and equally for the regulator as well. And it's really because this gives you the opportunity, if you spend appropriate time thinking about what's the severe yet plausible scenario, given the context within which you operate. It also gives you the opportunity to your point, to actually think about what's concentrations and correlations that you actually face in the organization. As we know, this is a known weakness of regulation. And I think the final key thing that it allows you is, as you do this, to actually identify plausible management actions that can really be deployed should you start hitting those early warning indicators and experiencing stress. I mean, if we look at Silicon Valley just from this perspective, a few things maybe to highlight. That risk management 101 point, they had the deposit boom coming through, didn't have the assets to deploy that in because of the concentration from a sector perspective, and managed to, in the low interest rate environment, push all that into long-term government debt. So that maturity mismatch wasn't picked up at all from a stress testing perspective. But interestingly enough, if you actually go and look at it, we did speak about the repeal, and the repeal really focused on liquidity and, like I said, the common stress testing elements. They still had to do stress testing internally, and from a regulatory perspective, they actually had to do your interest rate risk in the banking book, simple stresses of a 200 basis point shock in interest rates. And if you look at, I think it's the 10K form that actually is publicly available, if you look at it, you can see that they would have had significant equity erosion for a 200 basis point increase. And now to speak about management actions, to your point, in pursuit of that short-term profit and gain, in December last year, they actually took off their interest rate hedges. So it really does feel like 101.
So not having a collection of convoluted mistakes that were difficult to spot. I think a lot of what happened would have been fairly obvious as not being great, looking at the information that was just publicly available at that point in time. But I really like the point around the importance of stress testing is not a box checking exercise. Okay? It's not something that we do because the regulator says we have to do it, and you do it, with a certain set of scenarios that you're provided with and in a certain way. It is intended to be an extremely powerful tool for management, leadership, to understand where the organization is and how well it is positioned to withstand stress. And it really should be approached from that perspective. And I think where there are scenarios where it is considered to be a box-checking exercise, and when we're not able to tap into that fundamental ability to assess scenarios and assess our response to the scenarios and to pre-plan for our actions off the back of that, then we're kind of losing a trick there. You spoke about severe yet plausible scenarios feeding the stress testing exercise. KOKETSO, the economists are often the ones that are tasked with providing us with these scenarios. What would you say the challenges with this are that consumers of the forecasts should be aware of?
Where do I begin? I'll start with the obvious one, that some risks are difficult to predict. I think the pandemic or the lockdowns are a case in point here. But that said, the second one I think is probably more material for us as forecasters. Leanne has already mentioned that, our models are based on historical relationships. So most models are either calibrated or estimated using historical relationships. So when you have disruptions to market behavior, changes in market sentiment, innovation, such as the digitalized economy, that can change how those relationships work. And if you don't have that factored into your model, it can be easy to, miss that accuracy and get scenarios that make a lot of sense during these risk periods. The last one that I wanted to mention, it's maybe related to the paper that I was telling you about the IMF released in 2018. The fact that forecasters show some inertia or nostalgia in their forecasting process, baseline forecasts, which tend to be the basis of your scenario forecasting, tend to be also quite mild from a risk perspective. So that's something that we need to consider. Think about the context today where a lot of the market participants are expecting interest rates to be cut by a very large margin starting next year. And unfortunately, it shows that we expect the economy to go back to normal times, but there might be a new normal, right? We know that we're in a period of heightened geopolitical tensions. There's a very high demand for savings, whether it be to reshore supply chains, invest in in artificial intelligence, for example. Meanwhile, the supply of savings is actually slowing, right? Your demographics are not as supportive as they used to be. Population growth is slowing, even in China. So that means that cheaper labor is not going to be as readily available as it would have been in the past decade or so. So that mismatch in the supply of savings as well as the demand for savings for investments naturally means that you have higher equilibrium interest rates. We are in a period of geopolitical tensions, I've mentioned, that tends to be inflationary and also increases risks and risk premiums. So all of that put together means that you should have higher interest rates. So even in that context, you see the market and forecasters only slowly converging to that thesis. So it's something that we need to be highly aware of. Those are the limitations of forecasting and scenario analysis.
Brilliant, thank you so much. And I think probably quite relatable to actuaries, right? We also typically use our experience of the past, data based on that experience to predict the future. And it's quite difficult to adjust that kind of style of thinking to reflect new normals, the way that the world is changing. It's difficult. And so that combination between pure statistical analysis and forecasting and expert judgment and forward-thinking views is really important to at least try to get right. I think the other thing that happens is when we have conversations about models that are built by actuaries, data scientists, quantitative professionals in financial services organizations, we've at least gotten to the point of maturity to say, how do we manage the risk around these models? What are the conversations that we need to have? What are the sign-off processes that we need to take them through, and so on? How do we challenge them? And I think it's a great step in the right direction from days where you would kind of walk in and go, I'm the actuary, this is my model, and this is what it says, and everybody would go, oh, wise actuary, thank you for your wisdom, and not ask any questions about it. I do miss some things about those days, but not everything. I think the progress is good. I think we need to recognize, and speaking about artificial intelligence as well, speaking about lots of innovation in the way that we model things, I think we need to think about where there are models in organizations that are not obviously models, and where we need to apply the same rigor in terms of model risk management more broadly than we would to kind of the obvious ones. So I think it's worth something. It's something that's worth reflecting on. Thank you. Michael, you spoke about SVB being without a CRO. So Silicon Valley Bank was without a CRO, completely without a CRO for most of 2022. Additionally, of the 7 board members serving on SVB's risk committee, only 1 had some prior risk management experience, and none of them had ever held a senior risk role. None had ever been a CRO. So I think that's quite concerning to me, because it is the board's job to kind of make sure risk is managed appropriately. But Michael, I'm keen on your views on the role that senior leadership plays within the organization. And you mentioned remuneration as well, so I think that's important. But in determining or driving a strong organizational risk culture.
Right, thanks, Leanne. So, look, if you look at all these banks that collapsed almost the same time. So there was Silvergate Bank, there's this Silicon Valley Bank, there was First Republic, then you had Credit Suisse being rescued. A whole lot of issues happened. There was a bit of contagion, especially in the US. But all of that, there is always the human element. So there is always this people element. And I think, especially we as professionals probably, don't deal with the human element to the extent we probably should be, because we are highly technical. A risk culture in an organization is built from the top by the board. They must own that, and the senior management, and well communicated, well understood within the organization. Hold workshops. People need to understand it's not trying to stop business. In the case of SVB, as they were growing that fast, because the opportunities to grow were there, right? They were there, and they were incentivized to do that. The risk culture was poor because they actually incentivized excessive risk-taking. So it always comes back to the human element. So there's this human element that comes with it, because then moral hazard comes into play, ethical dilemma comes into play, and these are a lot of things that we debate with a lot of new qualifiers, when we do our professionalism course. And it feeds through into what strategy do you end up adopting? What business models do you end up adopting? Do you prepare well enough for your strategy, for your growth? Do you have a proper risk management framework in place? Do you have a proper contingent funding plan in place? All of this was not there at SVB. It was also not there at Silvergate. And that causes problems. So that's all driven by the human element. So imagine you've got a very good chairperson who understands risks, who says, I'm not signing off, I'm not approving what you have brought here. Let's go back to the drawing table. Let's talk again. Then things stop right away, right? Then everybody goes to corrective action. I don't want to just blame the management. There is also one element, the supervisors. So this was very clear in the report, the Basel Committee report. So the supervisors knew about these issues. They raised them. but they took a slower approach to addressing the issues. In fact, due to COVID, and you just mentioned, 250 billion assets below that, you don't have to be subject to Basel III and all these kind of things that came into play. So supervisors were also slow in responding, even if they raised certain issues with the Silicon Valley Bank, they did not enforce. They did not move to actually enforce. There was also that human element from the side of the supervisors themselves who knew what was happening. So I think everything, at least from my perspective, is driven by, there is always this somebody behind who causes that World War I, Thank you.
Thank you. Oh, absolutely. I suppose the stakeholder environment is quite complex, and that's just the directly involved stakeholders. You've got leadership, you've got management, you've got supervisors, you've got the people doing the actual work on the ground. And it really takes, I suppose, buy-in amongst that entire stakeholder group into that theme of what is it that we are trying to achieve. Is it just growth and profit? That probably shouldn't be the answer, because then you drive the wrong kind of behavior. So doing the right thing is something that really needs to be pervasive across all those discussions. So while SVB's collapse did not set off the kind of domino effect that gripped the industry during the global financial crisis, we did see global banking shares taking quite a knock, which signaled broader concern, and that concern has been articulated quite well in various papers that have been published since. Annelies, I'm keen to hear about your experience. How did banks and regulators respond in the aftermath, given the concerns?
Yeah, it's always risky answering the regulation question if you don't know who's in the audience. Maybe to highlight two key things to start off with. Look, I think first and foremost, we should acknowledge that regulation doesn't provide 100% fail-safe against failures. Its purpose is to make the probability lower, and its purpose is to insulate the failing bank from causing ripple effects across the wider industry. So with that in mind, I guess, maybe let's take a moment and just consider why these failures of the US regional banks was such a big deal. And I think we're talking, as I think you mentioned in your opening, about the quantum here. In aggregate, the failure of the three banks before First Republic was the same from an total asset perspective as the failures in aggregate of banks during the Great Financial Crisis. And that's really what started off the ripple effect and the concerns in the industry. Are we going to see global financial crisis 2.0 here? I think, second point for me here is regulators actually should be commended in terms of the swiftness with which they stepped in terms of managing the situation across the globe. And I think that really helped stem the tide in terms of the industry playing whack-a-mole with GSIBs. Credit Suisse is, for lack of a better description, the weakest link out of the GSIBs, did feel that, and we did see the consequences of that ultimately. So regulators did a good job in terms of providing liquidity, providing communication into the market to abate fears, and also actually in bringing banks together. We did see how quickly over the weekend the UEBS transaction got put together. We did see again with First Republic over the weekend how the concluding of the JP Morgan purchase also happened. So, I think that is quite commendable. I think from a peer regulatory perspective, maybe quite an interesting point to note was that depositor insurance point, where I did mention it's the first 250K that's insured by the scheme in the US. And ultimately, given the concentration, the FDIC did step out and say they'll guarantee all deposits, not just the first 250,000. In terms of what this means going forward, I guess that's the natural next question. I think the guys have mentioned the Basel Committee have put out their publication around lessons learned last week. Yesterday, the Financial Stability Board put out their publication. more focused on resolution and particularly on Credit Suisse. I think the key trends that I expect to see is probably firstly one of consistency, which I think you touched on as well, and that's consistency in terms of implementation of regulatory requirements. That is certainly the theme now with the finalization of Basel III as well. And secondly, it touches on that point around calibration probably of liquidity requirements, given the new world from a digital perspective in which we operate. Maybe just to bring it closer home, I think from a South African perspective, we don't have this divergence in terms of regulatory requirements between different sized banks. So we definitely don't expect to see the same causes from a regulatory perspective. But maybe on the flip side, we are at the start of our journey in terms of implementing a depositor insurance scheme and implementing a resolution framework. So it should be quite interesting to see where those land up now in the aftermath of this. And then maybe the final point around this is your point around, regulation normally gets calibrated for global systemic banks. And the importance of making sure that you understand how to adopt that in local markets. And then for your own bank's idiosyncratic factors is the best risk mitigant out there.
Brilliant, thank you. So maybe last question before we open up the floor for any questions from the audience. And really just kind of considering holistically the events that transpired and the background behind them, what would be the key takeouts, key lessons learned that our audience should take back for consideration within their own organizations? Michael, let's start with you.
No, thank you very much. Look, I'll be brief on this. So I think management and boards of financial institutions do not need to take things for granted. There is nothing new in what happened. It's just the environment that was different and maybe some of the drivers. But it's things that have been seen before, mentioned before. So maybe we need to be a bit more, look at things a bit more, a bit deeper, and understand what's happening. And this applies to business models. Like these banks were really unique banks in the way, in the markets they served, their franchises were slightly different from the norm. And it really required people to understand the implications of running such a business model. So I think from just management and board perspective, maybe that is a takeout, a lesson that people can learn. But you also have lessons for supervisors. I think there are a lot of things, Annelies, that you've mentioned, that supervisors did well in responding, like the final days when liquidity support was given and they moved in very quickly. So that's very good. But before that, the period to that, whether 2 years, there was a bit of slowness in responding and addressing the issues. And I think the supervisors themselves have identified that as an area to understand business models of a bank when you are doing the supervisory aspects of it. I don't believe in too much regulation, so there are lessons to take on regulation. I think it's more the implementation part of it. Yes, the issue of stress testing, recalibration of the liquidity measures probably needs to be looked at a bit more because of what we saw, but I still believe that it must be more in the actual implementation when you're doing these things and you're looking at the metrics you're looking at, and you stress it a bit and understand what action plans you have in place. That's probably what we need to look at. And I think those were also highlighted, like Annelies, you have said in the report that I spoke about. So I think that's what I can say at this stage. Thank you.
Brilliant, thank you. KOKETSO, closing comments from your side.
Sure, I'll try to be brief as well. Just have 4 comments. The first one would be, from a macroeconomic lens, these sort of risks and these sort of failures do result in a concentrated market where you have bigger banks, and unfortunately that results in less competition. It can also result in less financial inclusion. If you think about especially the moral hazard that we saw here, where this particular bank was lending to venture capitalists, for example, for innovation and so forth. You could also get a similar scenario where a bank is lending to your more informal market, and that would result in less financial inclusion, and those are the concerns that we have from a macroeconomic sense. The other issue from the monetary policy sense is that, financial systems, the fact that they've been designed in this way, there's some sort of systematic functioning, there's also some sort of correlation. It does also mean that if you do have less banks, less financial inclusion, less participation, because banks maybe are viewed as very risky, that does also impact the transmission of monetary policy. So when you hike interest rates, you expect those rates to filter through some sort of system and reach the public. So if you do not have as much participation in the financial system because of these risks, it does also impact monetary policy transmission. The second one that I wanted to mention is the depth of stress testing. I think we have seen certain risks being added to the risk matrix, whether it be climate change, natural disasters, so that's a positive thing. I think there also has been a bigger focus on other sectors within the financial sector, or other elements within the financial sector, such as the insurance companies, for example. There could be addition of non-banks, because those also raise some risks that could create contagion if not catered for. The third one, and the governor mentioned this earlier this year, which are fiscal vulnerabilities, right? And this pertains particularly to emerging markets, because we don't see fiscal or debt matrices improving anytime soon. So as you see banks taking up government paper, that only increases the risk of concentration of this paper in the banking sector. So that is a very big risk that the governor also mentioned. The last thing that I want to touch on before I end, sorry, Leanne, is the impact on monetary policy, the impact of monetary policy on innovation. Now, this is a paper that was released this year at the Jackson Hole Symposium, which, let me explain this. When we think about monetary policy, we think it's short-term in terms of its impact, so it's only cyclical. It doesn't affect the structure of the economy or the potential long-run growth. But if monetary policy in depressing global financial conditions, for example, does have an impact on innovation and the funding, rewarded towards innovation, it does actually affect the potential for the economy to grow in the long run. So this doesn't mean that monetary policy needs to be easy over the average period, but it does mean that there probably needs to be more policy coordination to try and support these companies that are investing in research and development. Thank you.
Thanks, KOKETSO. Annelies, closing comments from your side?
Yeah, I'll try to be very brief.
Promises.
I won't touch on the regulatory point. Look, I think for me, big macroeconomic shifts, which is what we see here. If you've got risk management weaknesses in terms of control, culture, capability, and you've got business model and strategy concentrations that you can't pivot out of quickly, will probably expose your bank in that situation.
Thank you.
That was short.
That was, thank you. No, but I think some excellent closing points, and I really like the point around the weighing up of the difference between the tactical way of thinking about policy and the more strategic sense. I think it's important, and yeah, we've been further served to highlight how complex these things actually are. Okay, that I think brings us to the end of our prepared part of the panel discussion. Happy to take questions from the audience on anything that you are curious about. Chris, I can hear you. Can we hear Chris at the back? No, you are sorted. There you go.
I have two questions. The first is, so regulatory compliance is obviously an issue. The UK's route, I guess in part, is to hold board members and certain executives liable for certain failures. Is that a potential route that we go in the US and certainly within South Africa as a means of ensuring long-term compliance? And is there potential room for even, say, limitations on remuneration so that there's less of a focus in the short term and potentially more of incentive for long-term views? And then my second question speaks to deposit insurance. There's obviously a potential morale hazard on that, but it is a means of pushing the cost of a failure onto the banking industry itself. Are there any other mechanisms for that which potentially incentivize banks to self-regulate more, so we actually don't need more regulation, we essentially have the industry itself keeping itself honest?
Thank you. Any volunteers? Mike?
Okay, anyone can go, but let's start with your question on the UK versus the US. Now, I think so in the UK, for example, it's already something that has been happening for some time. I've called it tick box exercising, tick box exercise towards compliance with regulation versus understanding. Actually understanding the risks you are taking. So the UK has already taken that approach. It's already incorporated in regulations. You've got basic core principles for effective supervision of banking institutions that the BESO has already given out there. Some of these things are already incorporated in there. From a US culture perspective, maybe this is another wake-up call to say this is going to continue happening. You probably need to be a bit more effective because we can actually see there were gaps and regulation. If we come to remuneration, I think that that story is already there, that we should be incentivizing more based on long-term incentive schemes versus short-term incentive schemes that we have seen at SVB Bank. That's something that's already known, that's already been debated around, not only within the banking space, but even across the financial services industry. So I think those are just things that need to be implemented. I go back to the human element. Remember we spoke about that. This human element, this professionalism course where every actuary must go back every 1 year or 2 years or 5 years, will help us get reminded about these things. That's my view. Thank you.
Thank you very much, Michael. Second question was on the deposit insurance scheme. Annelies, any specific thoughts on that?
No, I mean, it's an interesting question around whether or not banks will start to more self-regulate. Look, I think there's some examples of that already. If you think about default funds for CCPs, where banks actually put the money in upfront. I do think the implementation of resolution plans will probably force that in as well a little bit. But then I also think perhaps what we will start to see is, as regulators strive to implement things that are more standardized and consistent, it actually does take away, your ability to fully assess the risks that are idiosyncratic, either to your market or your organization. And therefore, perhaps the role of economic capital starts to play a more pivotal role in terms of risk management, which I do think sort of roundabout way gets you to that point around self-regulation.
Great, thank you. Okay, yes, please.
All right, thank you. Quite a number of analysts are of the view that the supervisor itself was quite complicit in SVP's failure, mainly because SVP was quite heavily invested in government bonds and in an environment of low interest that worked for the bank. But when the interest rate started to increase and the bank was faced with a liquidity problem, when they started to offload the government bonds because of the increase in the interest rates, then they were selling them at a loss. I'm quite curious to find out if you highlighted 31 unresolved issues with the bank, if the concentration risk issue was one of those 31 issues. And maybe a linked question to that is, to what extent can the supervisor take blame or the blame be apportioned to them in the sense that they also they were slow in enforcing regulatory compliance. So what actions were taken also against them to ensure that such issues don't happen in the future? Thank you.
All right, look, okay, let's answer you this way, okay? So there were a lot of issues here, a lot of many factors, convoluted factors that happened. So the first thing is, I don't think I would find blame with the supervisor on the investment strategy of SVB in holding bonds. I think almost every bank was actually holding those bonds, and they invested in those bonds when interest rates were actually very low, and then yields started increasing, and so almost every other bank was facing the same scenario, right? And they were U.S. treasuries. They are considered one of the best. So it then goes to what accounting treatment do you make for those assets that are held to maturity? And that's what supervisors are discussing right now, versus those assets that are said to be available for sale and those things. But I would hold the supervisor complicit in the sense that they identified the issues. And I'll give you one example where a memorandum of understanding is supposed to be drafted. I think that's in terms of the US process, when issues have been raised, and it took 7 months to do that. And by the time they wanted to deliver, the bank was down, right? But they knew these things. So, and they could have been a bit more proactive and done a bit more and allocated resources. There was also the issue of resources. So maybe there, I can say, well, they were also partly to blame in that area, but there were other issues happening where you might not even find fault in them because there were other pressures that were happening. So that's how I will answer you. I think there might be supervisors here. I don't want to lose my job. Thank you.
Fortunately, Michael's a consultant. Always worth. I do see that we are out of time. Are we able to accommodate one more question? Or?
Question very quickly, Leon, and then let's
Well,
go.
it's just a quick one, if you don't mind. Yes, the remuneration issue, I think, is really critical. A lot of institutions pretend to love governance and be committed to the highest principles of ethics, but what they actually do, they incentivize bad behavior. And now the problem with that is I've yet to see incentivization to put the brakes on. So if you are at the top of the cycle, everyone can see you're at the top of the cycle. You've been growing at 20% for the last 2 years. Actually, you need to pay someone to put the brakes on. And I have never seen such a thing. Thanks.
I think it's an excellent point. Maybe not a question to answer at this stage, but a very valuable insight. KPIs, so performance indicators and measurement of outcomes, need to align with that kind of corporate philosophy. Otherwise, you get what you measure. So a very, very strong point. Thank you. Okay, I think we'll wrap it up with that.
I think
so thank you all for being a fantastic audience today, and huge thanks to our panelists for joining us for today's discussion.